Welcome back. Many investors struggle with timing the market. That's why dollar cost averaging, DCA, is such a popular strategy. It removes emotions from investing and allows you to build wealth over time. But instead of guessing, I tested it on 150 stocks, 150 cryptocurrencies, and 150 ETFs. To make this fair, I only included assets that existed before 2020 and still exist today. Here's how we're testing it. We assume an investor puts $100 per month into every asset, from January 2020 to January 2025, right through bull and bear markets. We'll analyze which market performed best, stocks, crypto, or index funds. Also, we'll compare the risks and rewards. Let's start with stocks. Many investors believe picking individual stocks is the best way to grow wealth. But the question is, how many stocks actually performed well, and how many failed? Here's what I found. 124 stocks had a positive return. 26 stocks lost money. Average annual return of all stocks, 11.11%. Now, let's dive deeper into the top and worst performing stocks. Nvidia was an absolute powerhouse, delivering an 89.65% annual return. That means $6,000 invested over 5 years would have grown to over $45,000. But, this wasn't a smooth ride. Nvidia suffered a minus 62.85% drawdown, meaning at one point, an investor would have seen their portfolio cut by more than half. Broadcom and Eli Lilly also delivered fantastic returns with relatively lower drawdowns, showing that some sectors, like technology and healthcare, had strong momentum during this period. But not all companies were winners. Some well-known names performed terribly. Walgreens and Estée Lauder were the biggest losers, with Walgreens dropping an average of 43.57% per year. That means $6,000 invested would now be worth less than $2,000. Intel, once a tech leader, also struggled, delivering negative returns despite regular investments. This shows that even big brands can underperform, and picking the right stocks is crucial. DCA into individual stocks can work if you choose strong, long-term winners. But if you pick the wrong stocks, you could still lose money. Diversification can help reduce risk. Crypto is known for wild price swings. It offers some of the highest returns but also carries massive risks. I tested 150 cryptocurrencies and here's what happened. 103 cryptos had a positive return. 47 cryptos lost money. Average annual return of all cryptos, 18.82%. Let's look at the biggest winners and losers. Dogecoin was the best performer, turning $6,000 into over $232,400. But here's the catch, at one point, it lost more than 80% of its value. Other top performers, like Phantom and Chess Coin, had similar stories, huge returns but terrifying drops. If an investor panic sold during the crashes, they would have missed the gains entirely. But while some cryptos delivered insane profits, others were a disaster. These cryptocurrencies collapsed entirely. Voyager token, VGX, was the worst, losing an average of 78.9% per year. That means a $6,000 investment would be worth less than $750 today. This proves that if you pick the wrong cryptos, you could lose nearly everything. Many projects crashed by 70% or more, and countless others have completely disappeared. DCA into cryptocurrencies can lead to incredible gains, but also devastating losses. The key difference between crypto and stocks is that many crypto projects fail entirely. Exchange-traded funds, or ETFs, are often considered a safer and more diversified way to invest. But even within ETFs, some performed exceptionally well, while others struggled. Unlike stocks, which rely on a single company's success, ETFs spread risk by investing in multiple assets. Here's what I found. 118 ETFs had a positive return. 32 ETFs ended with a loss. Average annual return of all ETFs, 9.30%. Tech-focused ETFs dominated. SMH, which tracks semiconductor companies, was the best performer, delivering a 28.56% annual return. This means $6,000 turned into $12,123 over 5 years. These ETFs provided strong returns with lower risk compared to individual stocks or crypto, making them a great option for long-term investors. But not all ETFs were winners. Bonds performed the worst, with Treasury bond ETFs like TLT dropping by an average of -9.09% per year. This shows that while bonds are usually seen as safe, they can still lose value over time, especially in high inflation environments. While ETFs as a whole provided steady and reliable growth, their performance varied widely depending on the sector. Now that we've seen how stocks, cryptos, and ETFs performed, let's answer the big question. Which strategy is the best for long-term investing? Let's break it down. Cryptocurrencies delivered the highest average annual return of 18.82%, significantly outperforming both stocks and ETFs. But there's a huge catch: crypto also had the highest drawdowns, with many coins losing more than 90% of their value at some point. That means you could have made life-changing money, or lost nearly everything, depending on when you bought and whether you held through the downturns. So, while crypto had the best upside, it also carried the biggest risk. A strategy focused entirely on crypto could have made millions, but only if you had extreme patience and nerves of steel. ETFs were the safest choice, delivering an average return of 9.30% per year. While they didn't generate the massive gains of crypto, they also didn't come with the same extreme crashes. The best performing ETFs, like SMH and EU, offered returns above 20% per year, close to individual stocks, but with less risk. If your goal is to grow wealth steadily without stressing over crashes, ETFs proved to be a solid option. Stocks offered a middle ground, with an average annual return of 11.11%. They weren't as explosive as crypto, but they also weren't as safe as ETFs. The best stocks, like Nvidia and Broadcom, produced returns that could rival even some cryptos. However, others, like Walgreens and Estée Lauder, showed that picking the wrong companies can still lead to major losses. For many investors, a well-chosen stock portfolio may be the best mix of high upside and manageable risk. Thanks for watching. If you found this video helpful, be sure to like and subscribe for more insights. Now, I'd love to hear from you. Which strategy would you choose? Drop your thoughts in the comments below.